welcome. Thanks for taking the time out of your busy lives to join us today. I have the pleasure of, welcoming Jason Fial. I will give you a quick introduction shortly. Before we get into the introduction, I do want to jump to a couple of statistics that we have in regards to, wealth and managing your wealth, and then even having a wealth advisor. What is that for? So I just wanted to mention, according to the National Financial Education Council, a lack of personal finance knowledge can cost the average American $1,200 a year. That's something that we don't even ever look at, or usually we go to and overlook it. It's amazing how much a lack of financial education can cost us in the long run. So that's why it's so important to invest in our financial literacy. And I wanted to really make sure to create this webinar for that reason, that we can, really acknowledge those areas that we normally overlook and we don't look at so much, where financial advisor, for me, I consider it almost like a coach, a financial coach. If you take it, maybe it's downplaying it a little bit. At Astor Realty Capital, we are really committed to providing our clients with the education and the resources that they need to build a strong long-term financial success. So that's one of the reasons we wanted to bring Wilde Wealth today to discuss a couple of those topics that are really, really important. Some of them will be investment planning, retirement planning, estate planning, tax planning. We work with our clients to create really strategic, unique needs and goals, and, great advice. Another thing that I wanted to talk about is those with the plan are 2.5 times more likely to save enough for retirement. Those with a plan are 10 times more likely to reach their financial goals. So about 68% of people who have a financial plan also have an emergency fund. Fun fact. So I wanted to just real quick, Laura, I'm not able to see the pages, the projections, so I'm not really able to follow it along with what you're showing. A little bit about Wilde Wealth. Wilde Wealth brings a very, very personal approach. Wilde Wealth Management Group currently consists of 36 highly dedicated people, and they're growing. So dedicated to their clients. Wilde Wealth has been recognized in Barron's, America's top 1,200 financial advisors, their list of the 15th consecutive year. And they've been ranked #1 overall in the state of Arizona for this year, 2023. So today's topic with Jason, since I don't have the slides, like I said, I wasn't able to look at it. I'll jump to Jason to give a quick introduction about himself.
Yeah, happy to do so, Marika. So yeah, appreciate everybody being on the call today. We know time is money, so we appreciate your participation. I've been involved and know the folks at Astor for about 3 years now. They're as good of a company as you'll find. Their portfolio, the way that they do business is as good as you'll find in the industry, which is why we've kind of connected in certain ways to be able to try to support each other's client base for needs that my clients have and vice versa. So if you guys are investors of Astor, I think you guys should feel very confident that you're with a good group. As Marika had mentioned, so Wilde Wealth Management Group is the firm that I work for. We have 35 advisors currently. We manage about $2.8 billion and we serve over 3,500 households. So we're, it's interesting because if you compare us to the Merrill Lynch's and the Chases, we're very small, but as kind of an independent boutique advisory firm here in Scottsdale, we're very large. And there was just an ad or a piece that was put out by the Wall Street Journal where we were ranked number 82 nationally in terms of independent advisory firms. So we try to do the right things for our clients. We think we've been recognized for that. And really the goal for our firm is to try to be kind of the quarterback in developing the right financial plan for our clients. It's when you think of a financial planner or an investment advisor, some people think it's just money management. There's so many other things that a wealth advisor should be doing for their clients, which we will cover some of those today. So, our firm is a full service wealth management firm, and we need to partner and work with, companies like Astor for clients that have, they want to invest in real estate. Well, we need to have the right people to refer them to. Same on the tax planning side, estate planning side. So we're kind of, the people that quarterback the plan for our clients, but we help, clients invest money and build a financial future, protect it, and then distribute it, once they pass their loved ones. So that's kind of what we do. From a personal side, I've been in the business since 2006. For those of you who remember 2008, that was a tough year for the industry. So it was kind of, welcome to the party for me, but 17 years later, I'm here and stronger for it. But it's I enjoy what I do. I take my job very seriously. So there's lots of educational things we do consistently to be up to speed on all the different things that are going on in the market. But I've done it for 17 years, and I enjoy what I do, and I'm proud to be a part of Wilde Wealth. So that's a little kind of background on myself.
Thank you, Jason. So I'll go straight to talking also a little bit about Astor. And before I jump to that, I wanna say that I've been working closely together with Jason for over 3 years. And, sometimes it's not just about, having a specific wealth advisor or a specific person. It's really developing relationship over time, and it's the people you trust, and it's the people that we refer each other to. So a lot of those things play a big role. And I just want to mention, that the reason we wanted to make this webinar happen is because I trust what Jason is delivering and saying, and I feel comfortable to bring him onto our platform and introduce him to all our contacts. So a little bit about me. I'm a director at Astor Realty Capital, transitioning into a COO. My main focus is really on the operations of the company, as well as global investor relations, capital raise, origination on a lot of the projects that we bring in, and overall, involving in main areas of the company, making sure everything is running smoothly and maintaining all the proper relationships that we do. I've been with Astor for over 5 years now, and continues to stay here for a long time. A little bit about Astor. So we're a private equity firm. What we do is we partner with best-in-class developers and operators throughout the United States. We are institutionally backed, so that's a very important part. And what we do is we find the best ones out there in very strong markets, growing job growth markets, and we partner with those developers and we invest alongside them. We infuse capital, and then we bring investors alongside with us as well. Here, the picture that you're seeing here is a snapshot of, we've invested in over 12 submarkets in the United States, 12 states. We have a very strong portfolio, 2.24 billion stabilized portfolio value, and 3.6 million square feet projects under development. Some of the pictures that you're seeing here are some of the projects that we've considered our trophy projects that we're involved in. And we like to have a diversification in our portfolio and provide that to our investors as well. So let's move on. I'll get to the next page. Here's a snapshot of the different locations that we are invested in. And, we're always looking for new emerging and growing markets. We have a very strong eye on the strong markets right now, which would be, Florida, Texas, Arizona, of course, New York. We're very saturated in there. We look to invest in all different type of projects, multifamily, industrial, and hospitality, Class A. So we can move to the next slide.
That is it, Marika. I think that we're ready to
Perfect.
get into the
So
good stuff.
perfect. So let's jump to our first topic, which is the most important one. And we've been discussing this for over 3 years, Jason, you and I, we always bounce back and forth the conversation about, the financial house and building your financial house. So that is one area that I realized myself personally that I sometimes forget and overlook. And I wanted to start our conversation with that, what is building your financial house, and what are those areas that we normally think that are not part of, a wealth advisor?
Yeah, sure. No, I like that topic because it's kind of easy for people to understand. I mean, we either own a house, we live in a house, right? So we like to use those examples because people can kind of relate it and they can feel it to some degree. But when we talk about building, a financial house, really we talk about, building a house, right? So when you build a house, what's the most important part of that house? And the most important part is building a secure foundation, right? I mean, there's a quote that I read before that said, if you want your house to crumble, build it on the beach, right? Because you don't have anything that's secure to keep the house in place. So we always like using that topic because people can understand it. So when you're building a financial house, the most important part is the foundation, as I've explained before. And that's really the risk management side of your overall house, right? So a lot of times when people think about investing or a financial plan, they just think about just the investment part of it, right? And what's missed, and which is critically important, is making sure that you have the risk management part as the foundation. And that's insurance. Okay. So we're not going to, there's so many types of insurance nowadays. There's pet insurance, there's insurance on top of insurance. We're not going to get into all that. But there are four main pieces to your financial house from an insurance perspective that, in my opinion, are must to make sure that you're building your financial house appropriately. So the first is having health insurance in place. Okay. Critically important to have health insurance in place. If you become ill or you have an accident and you end up in the hospital for an extended period of time, you could have a six-figure bill. Okay. If you have over $100,000, doesn't even have to be that amount, but if you have a large amount, that will shape the financial course for your finances much differently than you anticipated. And the 401k, the IRA, the real estate that you want to invest into, you will not be investing into because you'll be paying that hospital bill for many, many years. So it's critically important to be sure that you have some form of health insurance in place. I know health insurance is very expensive. There's lots of different plans. I'm not an expert. I do know enough. You can even look at high deductible health insurance plans, and you can add health savings accounts onto them as well. That's something that we can talk about more off air if there's specific questions, but having some form of health insurance in place, even if it's a $10,000 deductible plan, that's better than having nothing. So health insurance is the first thing you must have when trying to build your financial house appropriately. The next piece is going to be life insurance. Okay. Most families today are two working parent families. And if you're just one, it's more important to have it. But most people are relying upon both incomes. If one does not come home, if one of the parents does not come home, then we have a major financial issue. Again, you will not be saving in your 401ks and retirement accounts because you're going to be worried about paying bills and putting food on the table. So having life insurance in place is really important. That is something that we plan for our clients. And there's lots of variables, but typically, depending upon your age and how much debt you have and what your asset level looks like, kind of the rule of thumb is having 10 times your annual income in life insurance. So if you make $50,000 a year, you should probably have $500,000 in life insurance. Okay. Now, the older you get, you become more self-insured because typically your debt levels are lower. You have less years you're going to work, so the income replacement part is less. So people who are close to retirement may need five times income. And if you're younger, you may need 15 to 20 times income. But having some form of life insurance in place is very important. The next piece would be disability insurance. And a lot of employers will offer this, which is nice and helpful. And there's two different types of disability insurance. There's short-term disability and there's long-term disability. Most importantly is having long-term disability in place. And I've done this again 17 years. What we typically see is some people will have life insurance, not as many as they should. I mean, pretty much everyone should, but maybe half of the clients I have when they come to me, I have some form of life insurance. Very few have any disability insurance policies in place if their employer doesn't offer it. And you're 5 times more likely to have a long-term disability than passing away. So it's critically important if your employer doesn't offer long-term disability to have that in place. Disability insurance just replaces a portion of your wages tax-free if you become disabled. So again, same scenario, if you become disabled and your family can't rely upon your income, it blows up your financial plan. Okay, so those are 3 critical pieces to have in place. Before you consider investing, etc., you must have those pieces in place. Now, the other part to building your financial plan, and we can talk a little bit about this later, but I'll touch on it now, is kind of the asset protection side. And that's your liability coverages on your auto insurance and or home insurance if you own a home. So what is very important is you can have the right health insurance in place, and life insurance and disability insurance. If you have car insurance and you have the state minimums for the liability side of it, which may be 25 or 50,000, you get into a car accident, you hit a doctor, and that doctor can never work again, they're going to sue you for whatever you're worth, right? Because now they've got lost wages for the rest of their career. You need to have the proper liability coverages on your auto insurance and your home insurance too, because there can be lawsuits in your home to protect your assets. Now, some assets are protected by statute, IRAs, 401ks, pensions, etc. Every state has a different Homestead Act in terms of the amount that is can't be touched for lawsuits. But typically what you want to do is if you have money outside of those retirement accounts, whatever those aggregate to, you want to make sure you have that amount of liability coverage. So if you have an accident, they come after your insurance and not your assets. Okay. So those are, and you can also, if you have a net worth well over $1 million, you can buy what's called an excess umbrella liability policy, which gives you an extra $1 million on top of your underlying policies, and it costs you $200 or $300 a year. So it's a good asset protection tool. So really, that's kind of the pieces that you want to look at first when you're building your financial house. Okay, now the second level will be asset accumulation. So that will be saving. Okay, and you can use 401ks, you can use IRAs, you can use Roth IRAs, you can invest in real estate, commodities, etc. Okay, but you don't start investing in those until you have the other items in place first. So those can be, again, Roth IRAs, which are tax-free later in life, and pre-tax accounts like 401ks or traditional IRAs are tax deductible today. Depends on your tax bracket. You kind of determine which one makes sense. But the second level is really asset accumulation, okay? And then the top level is asset distribution, okay? And that's going to be ensuring that once we get old, right, we want our assets to go to whom? Whoever that is, we want to make sure they get there efficiently. So the last thing we want to do is work, accumulate all this wealth, and then it goes somewhere we don't want it to go, or not as much of it does because of taxes, probate, etc. So ultimately, that's when you look at setting up wills and trusts, etc. And those things can actually help distribute your assets to your loved ones appropriately. So those are really, that's what a financial house is, but that's the order of priority, in my opinion, how things should be set up.
So first of all, I want to mention, wow, right there, like perfect misconception of what most people think a wealth advisor is, right? We think wealth, we think just, okay, talk about my money and where do I invest? So this is a perfect example of, every single area of our life is really covered. So that's what I meant. We're really having like almost, a coach with not just in your finances, but let's talk about what's going on in your life and how are we planning it really step by step. You talked about, the car insurance, the health insurance, the retirement, the taxes. By the way, for those of you that, are not familiar with Roth IRA or how does it work, we do have a webinar on that I've hosted last month. Laura will drop a link, or you can send her an email. We can send that out to you. So we have a webinar on the Roth IRAs as well. So you're welcome to watch and get educated about that as well. So, thank you, Jason. I want to also address one question in regards to that. So, all those different areas and the topics that we've touched, I want to talk about, how important it is, and then at what stage do you start? I mean, I know with car insurance and all those things, it's a little bit different, but if you can touch on, what stage is the most important when a client does sit down and talk to you and say, hey, I want to look at all of those areas together with you. What's the first place I want to start? How important is stage 1, 2, and 3? And then I want to also address, when someone does sit down and talk to a wealth advisor or with you about those topics, how does that work? How does that the payment work? Is it like an annual thing? And I want people to really understand that area as
Sure.
well. Well, let's
Yeah,
touch
sure.
on that.
Yeah. So in terms of, I think really once you're making money, quite frankly, once you have wages and you're able to get to a point where you can start saving, that's when you need to start considering those ideas, those concepts. Right now, even if you could be out of college and you could be single and you're not worried about saving for retirement. I mean, you should, but most people aren't if we're being realistic, right? And you don't need to worry about having high liability coverages because you don't have anything to protect, right? But you should have some form of health insurance in place. You probably want to have disability insurance because you can't work and you need to be able to pay your bills, right? So I think it starts as early as once you're actually earning money, you can start with that conversation, and then as you start to save more, then there's going to be more complex needs that you have, and then all those other items will kind of come into play. So, unfortunately, what a lot of advisors do not talk about these things, and I want to transition this into your question about how do financial planners charge, right? How do we work, and it's different
So
for everybody.
It's, first of all, it's so important, and then it's also an area that some people might not feel as ready to ask. Maybe they're just like, okay, if I don't even want to bother going there because maybe I'll just even get charged for even asking the question, or is this something I can even ask a wealth advisor?
Right. No, it's interesting. And I can't tell you how many clients I have that, have an attorney for whatever the reason may be, estate planning, family law attorney, asset protection attorney, and they will call me and ask me the question. And they say, I don't want to ask my attorney because they're going to charge me if I ask them the question. Right. And I laugh because I'm like, that's such a backwards way of running a business, because our job is to offer advice, yet the way that you're structuring your fees encourages people not to ask those questions, right? And it's funny to me. So there's lots of ways that advisors charge. The most typical way is if someone invests with us, there's what's called an asset under management fee. So if someone comes to our group and says, I got $500,000, can you invest it for me? We will charge a percentage, okay? And typically, depending on the dollar amount, it's around 1%, could be a little bit more, could be a little bit less. And then that's how we charge. So and that encompasses everything. So that's kind of one way where we charge, where someone comes to us, we charge to manage their assets, then all the other planning that we do, we include in that fee, okay? And ultimately, that's typically the best way for the client to be charged, because number one, we're not charging you for several different things. And number two, our goal, if someone starts with $500,000 and then 5 years later it's $1 million, they're happy as a client and we're happy as their advisor, because now we're making a percentage on that higher dollar amount, right? So for lack of a better term, we're kind of in bed together, and that's what you want. Now, rewind to last year, not a fun year for me. Markets were down 20%, which means our income was down 20%, and we didn't have happy clients. But that's just part of the process, right? So what you don't want to do, in my opinion, is charge someone a fee where it doesn't tailor to what their performance is, right? So that's typically how advisors will charge. But you also have advisors that will also charge to do the planning that we will do for free for clients. So we'll build out financial plans. We will talk about estate planning, tax planning, all of those things. And some advisors will charge hourly for that. But it is very interesting, Marika, that you mentioned that clients sometimes can be uneasy in asking, how do we charge, right? And I can tell you, probably 3 out of 4 clients that I work with in our first meeting, they don't even bring up the fee conversation. I have to bring it up to them because it's almost uncomfortable, and it shouldn't be. I mean, it's like if you were going to go buy something and you didn't know the price tag, would you go buy it? I mean, you wouldn't buy it until you know what you're buying, right? So anyone that's working with an advisor, you have every right to ask how they charge and make sure it fits what you want, because otherwise you really have no idea what you're signing up for.
I mean, I think that's the whole point of an advisor is, right? Is I have the advisor by my side that I can ask all those questions. Hey, I'm talking to an estate planner. This is what they're talking to me about. This is the prices they're giving me. Hey, I'm talking to a tax accountant, right? So with all those different areas of our life that we're involved in, the wealth advisors kind of come in and touch on all of those areas and really provide that guidance and that support alongside all of those areas that you need to address in your life. That's the way I see it, and that's what I'm hearing from you and working and learning from you for the past 3 years. That's what I've been hearing as well. Also, when, for example, I want to take the opportunity to maybe have anybody jump in right now and ask some questions live on this specific topic that we're talking about. After this, we're going to move on to tax planning strategies, asset protection, and estate planning. So before we jump on to that, I want to just, have 1 or 2 people. All you got to do is just, press on the raise hand button, and I want to give you an opportunity to ask Jason a question, as if you're sitting in his office. So here's your opportunity to jump in. And while we're waiting for that, for people to raise their hand, I want to also maybe suggest, because we are planning to have ongoing Zooms and things like that. So anybody that does have a question that they want to send in, or if you want to have your own meeting with Jason, we're happy to provide you with that information and give you some guidance. So we do have a question from Dejanith. Hi, Dejanith. Good to see you. Thank you for joining.
Thank you. I have a question. Between a Roth IRA and a universal life insurance, an index universal life insurance, which one is better?
It really depends on what your need is.
For retirement, for instance.
If it's just for retirement purposes, the Roth IRA is going to make more sense, because the universal life policy, index life, variable life, whatever it is, has insurance cost in it. Okay, so the insurance cost comes out of the return. Unfortunately, what happens in our industry is all those life policies are marketed in ways that they're not intended for. And the reason being is because they're highly commissionable for the advisor. So unfortunately, they are misused. I'm not suggesting that's happening for you, but sometimes people don't understand why they're buying it. And you can use it, first and foremost, it's a life insurance policy. If you don't need life insurance, you shouldn't be buying it. Plain and simple. If you want to have permanent life insurance and you want to build some cash, then it could work. But if it's just for retirement and tax-free assets in retirement, Roth IRAs are far better.
Thank you.
You're welcome.
Thank you for that, Jason. So I don't see anybody else's hands raised so far. Let's move on to, our second topic, which is the tax planning strategies, estate planning, asset protection. What are the biggest points you're seeing when clients sit down with you and they do discuss those areas? What are some of the most important parts?
Yeah, let's start with the tax side. Nobody likes paying taxes, right? Nobody
Right.
does. What's interesting though is if you look at the historic tax rates, we're actually in a pretty low tax environment if you look over the last 50 years, but still, it's always too much, right? So we always try to find ways to mitigate that, and a lot of it depends upon your current tax situation and what you want those funds to do in retirement. And we kind of look at from a tax strategy perspective, kind of the two bucket approach, right? And real estate in a way kind of falls into that because you can put money in and it grows tax deferred, right? So it has those nice tax efficiency qualities. But when we look at kind of tax planning, from my perspective, we're not talking about really deductions. That's more of a topic for your accountant. But in the investment world, that's your retirement account. That's your 401k. Could be an IRA, could be a Roth IRA, et cetera. Defined benefit plans for business owners. So there's lots of things you can do. HSA accounts, which I talked about, I'll touch on that real quickly. But ultimately, when you invest in a traditional IRA or a pre-tax 401k, you are putting money in a retirement account and the government is giving you a tax deduction today on the contributions. So for example, if you put $10,000 into a 401k this year, and you are in a 25% tax bracket, you just save $2,500 in taxes because you're not being taxed on that $10,000 you're putting in. Okay. So if you say, I want to reduce my tax liability today, then putting money in a pre-tax 401k would be beneficial. Same as a traditional IRA. If you don't have a 401k at work, it works the same way. Now, the government says, if we're going to give you a tax benefit, you can't take the money out tomorrow. This is going to be used for retirement and you can't take it out till you're 59 and a half, or you pay a 10% penalty. So I tell people it's kind of the set it, forget it money, right? You put money in a traditional IRA, pre-tax 401k, same with Roths, which I'll get to, but that's set it, forget it money, and it gives you that tax deduction today. But when you take the money out, you will pay tax on all of it. So the thought is, am I in a lower tax bracket today than I'm going to expect to be in the future, or am I in a higher tax bracket today? And that will drive the conversation on which account you should be investing in. So that will help you save money in taxes today. Roth IRAs are just the opposite. So you put money into a Roth IRA or a Roth 401k, and you get no tax deduction today, but all of that growth is tax-free later. Okay, so what's important to kind of look at is, the tax part of it too. What's my bracket today? What do I expect it to be in the future? Nobody knows. What I can tell you is we're $32 trillion in debt as a country, and the only way to pay that down is to raise revenue through taxes. So at some point, taxes will go up. I don't know when. Hope it's not my lifetime, but more than likely it will be. So the Roths will give you tax-free growth over time. So if you're younger, Roth IRAs make more sense typically because you have all those years you're deferring and all that growth is tax-free. Now, the reality is we don't know what taxes are going to be in the future. We don't really know what your income needs going to be in the future to some degree. So what we typically recommend is kind of having a two-bucket strategy where you have both. So you can have some in a pre-tax account, some in an after-tax or a Roth account. And you can grow those kind of in unison to some degree. So when you do retire, now you can look at what's the current tax environment. If taxes are high when you retire, and that all depends on who's in office typically, right? So if taxes are higher, then you're going to take money from your Roth. If taxes are lower, you're going to take it from your pre-tax account. But you have to have both to be able to do it. So we typically encourage people, try to get money into some pre-tax and after-tax accounts because it can benefit you later. Now, HSAs, which are health savings accounts, so those can be attached to a high deductible health insurance plan. These are the most tax efficient accounts you can invest in because the money you put in goes in pre-tax, meaning you get a deduction on it today. You don't pay taxes as it grows. And then when you take it out for qualified medical expenses, you pay no taxes on it. So it has 3 out of 3 tax characteristics where the pre-tax accounts have 2 out of 3 and the Roth have 2 out of 3. So you can use HSAs as a vehicle to save for retirement as well.
So just real quick, I had somebody ask if you can repeat that portion again. I believe it was an important part, and just a small portion. Can you repeat that?
Just the pre-tax part, or kind of just a little bit slower in terms of what I just mentioned?
Yeah, what you just mentioned.
Okay, so really the retirement accounts are deemed by the IRS. They give you tax benefits, but you can't take it out till you're 59 and a half. That's what they deem retirement age. And you basically have your two buckets. You got your pre-tax buckets, where if you put your contributions in, you get a tax deduction on those contributions. So it lowers your taxes today, but all of that growth later when you take it out will be taxable at your tax rate at that point. The Roths are just the opposite. When you put money in, you get no deduction today, but all the growth is tax-free later. I hope that answers the question.
Yes, yes, thank you so much. And you touching on so many areas that are really, really important for people. And you know, uh, I wanna also take the opportunity while we're speaking on the tax subject and the Roths. There were a lot of things that you've mentioned that, probably most people haven't heard before. So I do want, guys, raise your hands and jump in. This is a really good opportunity to ask all those questions. You are sitting down with, like, really generous wealth advisor that's giving you a lot of information. We do have one question. So who would you use to open a self-directed IRA? I mean, go ahead, Jason. I can answer that, but I'll have
Well,
you.
it kind of depends on, I mean, sometimes they're more localized. We don't do self-directed IRAs, but I don't know if Schwab or Vanguard, some of those companies do. There's a company out here, and it maybe this is helpful to some of your investors too, to some degree. It's called Vantage, Vantage. They specialize actually in holding real estate in qualified plans. So that's someone that we're familiar with out here in Scottsdale. But that's the only custodian that I'm aware of.
And then what about who would you use to open a HSA?
There's not many options. So I use a bank called Optum, so OPTUM. They kind of own the space, Optum Bank. Most of them, they're very reasonable from a price perspective. There's not any management, so you got to pick out your own funds, et cetera. If you work with an advisor, they could probably help you with that. But they're inexpensive to set up. That's who I use personally. I don't know if there's others that are better, but they're pretty big in that space.
Perfect, thank you. And Laura, if you can find that, we can drop the link in the chat for people to look that up. So let's jump over to, estate planning, wills, trust.
Yeah.
What's most important? When do you start that? Should people even consider it?
Yeah, I mean, once you turn, and when we talk about estate planning, typically it's wills and trusts, but it's also powers of attorney, right? So we work with many estate planners out here, and what I'm told, and it makes sense, is once you turn 18 and you're a legal adult, you need to have your powers of attorney in place, because if you end up in the hospital and you're incapacitated, your parents cannot act on your behalf at that point. So you need to have a power of attorney in place, naming them to act on your behalf. So you can do some of that planning as early as 18. But typically, once you start generating assets, if you get married, most importantly, if you have kids, then you want to make sure you have wills in place that name guardianship. So what gets confusing is wills and trusts are really two different things, okay? A will can state where you want things to go, but certain assets will go into probate even if they're in your will, okay? And probate's no fun. So what a trust does is, a trust is only, and there's lots of different trusts. I'm talking about a revocable living trust, like a family trust, okay? Those are designed to do two things. They're designed to keep things outside of probate, okay? And the probate process, by the way, is probably different per state. But if your assets go into probate when you pass, your kids probably won't have access to it for a year. And the average cost is 5% of the estate value. It's extremely expensive. So you don't want to go to probate. So if you title your assets appropriately, or you beneficiate them appropriately to the trust, you won't have any probate issues. And it gives you control. So and this just depends on the person and the family. Some clients say, when I pass, whatever the kids get, they get. Okay, that's cool, right? No big deal. Some say, I want to ensure they get X amount and their grandkids get X amount. And I want control over that. So we call it control from the grave. That's what a trust can do. So you can put language in the trust. When I pass, I want X amount to go to my kids for this reason. I want X amount to go to fund my grandkids' college. I want X amount to go to buy their house, whatever it may be, and you can control it. If you don't beneficiate your assets to a trust, it will go to whoever you beneficiate them to, and they will have full control of those assets. In some situations, parents don't care. In some, they do, because some kids aren't good with money, right? They may have things going on in their life where we don't want to dump hundreds of thousands of dollars into their pockets. So we need to put conditions in place that the trust can do. So the trust is really a financial piece. The will, you don't have to put everything in a trust, but the will is more on the guardianship side, and you can leave assets. You don't have to have a trust, but if you don't have a trust, some things will go into probate. So you can use them both in combination with each other. But the whole idea is to have those in place so we can make sure once you pass that everything goes to your kids appropriately from an asset perspective via the trust. And then you make sure if you have minor kids that you have guardianship in place, because that's typically the most important thing for the parents, is making sure that their kids will be looked after by someone that they trust.
And in regards to that, for example, for those who haven't considered that, what would be the first two most important areas to consider when looking at trusts? What would you advise to do? Okay, fine, I want to do it. Like, how do I know if I can qualify? Are there qualifications for that? Can you touch on it just a little bit?
Yeah, it's a good question. So a lot of times, you hear of trust funds, and I have clients that say, well, gosh, I don't need a trust. I don't have enough money, right? And I kind of laugh and I say, well, that's not true, because you can set up a trust if you have $50,000 to your name. If you want that $50,000 controlled to your beneficiaries appropriately, whether you have 50 million or 50,000, the trust does the same thing. Now, if you have 50 million, there's a lot of other things you got to do from a trust planning perspective, but the trust just gives you control, and you can ensure that things go to your kids appropriately. So there's really not a dollar amount. Now, you have to be aware of the cost to do it, right? So if you hire an attorney, they can be $2,000 to $3,000. If we're talking about leaving $10,000, the ROI doesn't make a lot of sense, right? But you don't have to have a large estate to consider trust planning. You really don't. And from a will, really everyone should. If you don't have a trust and you don't have a will, and the investments you have don't have named beneficiary clauses, then the state will determine where your assets go to. So at a minimum, you need a will to say, here's where I want these things to go to. Even though they'll go through probate, at least they're going to get to the beneficiaries the way that you want. So those are the things to consider.
Okay, so let's jump on to let me just take a moment. I do want to take this opportunity, guys, raise your hand so I can call you out on some of the topics that we just discussed. I'm sure there are questions out there. Let me just
Yeah, what I would say too, Marik, I mean, this is a lot of information. We're just scratching the surface. So, after the fact, I'm more than happy to have conversations with as many people as possible, really about like what their potential questions would be for their situation, right? Because sometimes you don't want to ask that in a public setting, but I'm certainly available to do that as well. So I just want to make that clear.
Thank you, Jason. Appreciate that. Actually, we have Joe Burko. Hi, Joe.
Hello.
Hi, how's everyone doing? Hey, Jason, good to see you.
Yeah, you too.
Excellent, excellent info. I really appreciate this, and I think a lot of our partners and investors are appreciative as well. And I think you're doing a great job, and please continue. You did cover a lot of ground, and I highly recommend to have folks reach you, and have a one-on-one conversation, because some of that stuff is even hard for me to follow, and I'm somewhat familiar with that stuff. But I want to ask you a very different question. So obviously we're all gung-ho in real estate. We're real estate guys. We do our strategies from investing in debt and pref and equity and all those different things. The world is somewhat an uncertain territory right now. And we always say to our investors, the alternative side of your investment, in our case, real estate, cannot be your entire portfolio. You simply have to diversify, just the very same way that I'm not in favor of investors just putting all their capital into stocks and bonds. I'm not in favor of our investors putting all their money into one asset class, real estate maybe, or any other way, shape, or form. How do you advise today? We'll have people coming over to you. What do you advise them today? And what sort of tools do you have out there to create diversification?
Yeah, no, it's a good question. So, one thing that worked really well last year for the most part is alternative investments, which real estate falls into that category, right? So, typically when we're investing for clients, the major asset classes are stocks and bonds, right? And when you own stock, you're a shareholder of the company, and when you own bonds, you're a creditor of the company. So typically, stocks and bonds work inversely of each other. So one goes up, the other goes down, like a teeter-totter, and vice versa. The challenge last year was they both went down considerably. So you always want to have some additional exposure to alternative investments, which could be commodities, but just as important, real estate, right? Because those don't have the same correlation to the market as stocks and bonds do. So we have all sorts of software programs, by the way, and it's too deep to get into, quite honestly. But diversification is key. It's risk management within your portfolio, and you have to have a little bit of everything. And your advisor should be, advising you specifically on what's your risk level, when do we need income. And that's how you design a portfolio. But you still need to have exposure to broad asset classes, because if you ask me what the market's going to do in a month, I have no idea. 10 years from now, the market repeats itself. I know that, but in the short term, diversification is key. Like 100%.
So thank you for that.
Yes, thank you, Jason. And thank you, Joe, for the question. We do have Jason's contact information in the chat. You can go ahead and copy that and contact Jason, reach out with whatever questions you might have. So Jason, we have left at least another 10 minutes. So before we end our conversation, I do want to, can we touch on the subject of what are the most important questions that you are getting these days, and what are some of the challenges that you're seeing people face, and how do you help them in those areas?
Yeah, I mean, it's just we get all sorts of questions, quite honestly, but the main question that we get is just people are very concerned right now about the economy,
Yes.
about the markets, and they look at their accounts and they're down quite a bit from 15, 16 months ago, right? And what we always try to tell people is you don't change your plan because of a short-term blip, right? I've got a chart in my office that shows the inception of the New York Stock Exchange in 1926, and it's just like a graph that just does this, right? What happens is, like, the further you go to the right, the more up it goes, and it lists all the different events that caused the markets to go down, right? Like the Great Depression and World War II and .com and the Great Recession, COVID, all of that, right? And the main theme is, as long as you stick to your long-term plan, you'll be okay. Now, you have to have a plan. That's the key, right? And most people don't have a plan. And what I try to explain to people is, number one, and this is easier for people to understand in real estate because most people have owned a home at some point. People don't understand the markets. If you're diversified appropriately, you should own thousands of companies in every sector of the world, every part of the world and every sector of the economy, excuse me. So you should be very diversified. And it's like, one goes up, one goes down, vice versa. That's what the diversification is. But people are concerned that, if the market crashes, could I lose all my money? And if you're diversified appropriately, no, you can't. And the key is, if you can avoid it, you do not sell in the down market, because there's what's called unrealized losses and realized losses. Okay. So when you look at your statement today versus 16 months ago, you're going to be down. Now, if you don't sell, you technically have not realized that loss. Okay. And I try to explain to people, and the markets are probably similar in Florida and Arizona from a real estate perspective, right? So you remember back in 2006, 2004 to 2007, where the real estate market doubled, right? That's crazy, went bonkers. And then from about 2008 to 2011 or 12, it cut in half. And what I ask my clients is, in 2011 and 2012, when the value of your house dropped 50%, did you consider selling it at that point? And they look at me like I'm crazy, right? Like, why would I sell it when it's down 50%? And I tell them it's the same thing with your portfolio, right? You realize the loss when you sell it. If you look at real estate today, it's far more appreciative than it was in 2012 and even 2007 when it was the top, right? So you have to stay in, but you have to have a plan to be able to provide comfort and income for clients when markets are going down. So that's kind of the key. And one of the slides at the beginning mentioned you're 10 times more likely to meet your financial objectives if you have a plan, and it's true. So with really every client we work with, we will build a financial plan for them that will state, if you want to retire at such and such age, and in today's dollars, you need X amount of income, how do we get there? How much do we save? How much risk do we take? And it runs as many back-tested scenarios as you can imagine. And it's not foolproof, but it's a nice blueprint to show people, here's what you need to do to get to where you want to be. And you can't plan appropriately if you don't have that, because you're either going to do one of two things. You're not going to save enough, and then you're going to wake up when you're 60 years old and say, gosh, I can't retire anytime soon. Or you may be saving more than what you'd like, and then you're not doing the things you want in your life today to enjoy your life, right? Because it's not, I always tell my clients, look, it's not about just saving and saving and saving and saving. That's not realistic, right? You got to live your life, and you want to find that balance, but you don't know that balance until you have a plan that shows you all of that, right? So having some form of a financial plan is critically important. Most people don't. And what's even more concerning is, I would say 9 out of 10 clients that come to me from another financial advisor do not have a plan. They just manage their assets. And by the way, as I mentioned early on, typically how we are compensated as advisors is just by managing your assets. So what do a lot of advisors do? So manage your assets. All of the other things we talked about, which is like 80% of what you need to do, they don't talk about, which is a massive failure on their part. So planning is critically important, and it needs to be part of what you do to ensure that you meet your goals financially, or you'll wake up one day and it'll be a scary surprise.
Yeah, that's a really good point, and a great way to kind of, end our conversation is, understand the importance of planning on all areas of your life, understanding the importance of having somebody by your side to help you, really guide you. It's kind of like, when we were talking about that the other day, when we were saying, really having that plan. Today, most of us use navigation, right? We put the address and we have a plan. I want to get from A to B, and this specific product, whichever one it is that we use, is going to help me get there and give me the direction. So if we didn't have the direction, we'll get lost or take much longer to get there. So we rely on getting to the right direction. So imagine in the areas of finance and tax and health and real estate, financial planning, retirement, all of those areas, to have the right person by your side to help you, guide you, and give you that right direction is really key. And I feel like it removes a lot of fears too. It removes a lot of fears and gives us comfort and ease.
Yeah.
So again, thank you so much, Jason. Really appreciate you joining us and for your amazing wealth of knowledge. His information is in the chat for those of you that want to reach out to him. Of course, we'll send it out to you as well. And looking forward to our next wealth series. Please do join us next month. You'll be getting the information. Jason, anything you want to add before we end the call?
No, I think that's it. I think we covered a lot, and I would just say it's really important to take control of your own financial future. No one else will do it. You've got to be really involved and take the first steps, and then work with people that you trust. Definitely.
The trust is a big place. So trust and referrals is really good. Trust and verify, and ask a lot of questions.
Okay.
That's what we touched on today. Everybody, thank you for joining, and we'll see you soon.